So close. Can you even get the picture?
What's up, everyone? Welcome back to another episode of Financial Finesse. I'm your host, Jabari Elliott. Today, we're going to discuss a topic a lot of people have been asking me about, and that's how to trade options. Due to the complexity surrounding options, this will actually be a two-part video. So make sure you like and subscribe so you'll be notified when part 2 drops later this week. And with that, let's get started. Options are financial instruments based on the value of another underlying asset or financial measure, such as stocks. The traditional buy and hold strategy works well for stocks and ETFs, but not always for options. This is due to the time limit in the life of an option. As you may be aware, there are two types of options: calls and puts. The function of these two options are virtually opposite, allowing investors to participate profitably in both bullish and bearish markets. I typically use options to limit my risk, but they can also be really good tools for generating income. For new investors, the primary focus should be understanding risk associated with option tradings before buying or selling contracts. This may require a deeper analysis beyond considerations for traditional stock investing. Because volatility is a key component of option pricing, the underlying stock's volatility will have to be carefully considered to ensure the best financial parameters for your investment strategy. When a new position is created, one of two things is triggered. By buying an option, you are acquiring a set of rights. By selling an option, you are acquiring a set of obligations. In the US, options are guaranteed by the Options Clearing Corporation, so you never have to worry about who's on the other side of a transaction. Primary risks involved in option trading include time value decay as well as leverage, both of which stocks do not possess. Leverage causes option prices to change in larger percentages relative to the underlying movement, while time value decay causes option value to decrease as the expiration date approaches. The rights acquired when buying a call option allows an investor to do three things: buy a specific quantity of the underlying stock or exercise, buy the stock by a certain date, aka the expiration date, and buy the specific quantity of stock at a specified price, aka the strike price. While the cost of the rights acquired through the option is fixed, the price of the call option rises as the underlying stock price rises. Conversely, a put option gains value as the underlying stock price moves down, and both call and put options have risk associated with time value decay. Now, the movement price up or down must occur before the option contract expires, or the contract will expire worthless. Rights associated with buying a put contract include selling a stock by a certain date at a specified price. For example, if you buy a put and own the rights to sell a stock at $30, but the price of the stock falls below $30, those rights become more valuable. Even if you decide not to exercise those rights, you can still sell the option for a higher premium than what you originally paid. The hardest part of option trading is selecting options with expiration dates that allow for the anticipated movement in price to occur. All optionable stocks and ETFs have multiple expiration dates and strike prices to choose from. Options with more time to the expiration date are more expensive. Options with strike prices closer to the underlying stock's current price are also more expensive. When you buy an options contract, you have two choices. You can exercise your rights, or you can trade your rights away based on current market conditions. Put options are usually used in one of two ways. One, to reduce risk via hedging a particular portfolio position. Hedging is a risk management strategy used to offset losses by taking an opposite position in a related asset. If you want to learn more about hedging, check out my video on income investing, where I detail this and other risk management strategies. And number two, put options are also used to capitalize from falling markets during bearish periods. For riskier investors, options can also be used to leverage positions. Because options cost less than stocks, investors can participate in the market for less than the cost of owning actual shares. Meaning, a $1,000 investment in option strategy may provide more potential profit than a $10,000 investment in individual stock. Now let's review some basic fundamentals about options. Options are investment derivatives that derive their value from underlying securities such as stock. Other derivatives include commodities and futures contracts. And while ETFs are sometimes referred to as stock derivatives, they are actually quasi-derivatives, but are still impacted by underlying stock price. As mentioned earlier, a call option gives the owner the right to buy a certain amount of stock by a specific date at a specified price, and gives the seller the obligation to sell. As the stock price rises, the value of the call option also increases. A put option gives the owner the right to sell a specific amount of stock at a specified price before a predetermined date, and gives the seller the obligation to buy. The value of a put option increases as the underlying stock price decreases. Now, all options come with limited life. Each options contract has an expiration date, meaning if the anticipated move doesn't happen before the expiration date, then the entire initial investment may be lost. And that brings us to our next topic, how to value options. To fully understand the risk-reward payoff around options, one must also understand how the investment is valued. Valuing options requires knowledge of 4 characteristics. 1, the type and strike price of the option. 2, the price of the underlying security. 3, the time remaining until the option expires. And 4, the past volatility of the underlying security. Between the time you buy an option and the option's expiration date, you can sell the option prior to expiration, manually exercise the option, or let it expire with no value or with value, in which case the option will be exercised on your behalf. An investor can also sell options that they do not own in a process called selling to open. This is a little more complex, but is explained further in part 2 of this video, Options Trading 102. For now, we will focus on buying options to open contracts. In addition to understanding option value, one must also be aware of commonly used terminology in options trading. So let's run through a few next. The underlying security is the stock or other security that determines the value of the option. The strike price is the price to be paid or received if an investor decides to exercise their rights on a call or put option respectively. The expiration date is the date in which the option and any associated rights or obligations disappear. The option deliverable is the number of shares of the underlying security to be either called away or put to someone. The most current price for an option is called the market quote. The number used to determine the value of the option is called the multiplier. And this tells you how much money is to be paid when shares are called or put to someone. And lastly is the premium, which is the total value of the option determined by the market quote and the multiplier. Now let's discuss those option expiration dates. As time passes and the expiration nears, options lose time value, and the value of the option drops faster and faster as the expiration date approaches. Before trading options, be very clear on what you are trading and how much time the option has before the expiration. To maximize odds of success, an investor should have a good idea about what they will do with any open option position well before it expires. Generally, holding an option with 30 days or less to expiration is ill-advised, as the time value will rapidly decay and the option price will decrease. However, for riskier investors, all options may be gained, especially options with underlying stocks that have more movement than average. To reiterate, when an investor buys a call option, they are buying the right, but not the obligation to buy a specified amount of shares at the strike price sometime before the expiration date. Conversely, when an investor buys a put option, they are buying the right, but not the obligation to sell a specified amount of stock at the stock price, but still before the expiration date. We will discuss option obligations further in Option Trading 102. However, these typically apply to investors who sell options to open positions, a tactic not really suitable for new investors. Not to get it confused, it is quite possible and likely probable that an investor never exercises their rights associated with an option. And this is because it is not necessary to exercise option rights in order to profit from options trading. The rights associated with option buys gives the investor the option to make whichever choice aligns with their investment goals. However, if you decide to exercise an option as opposed to selling, there are some advantages. When you exercise a call option, you may benefit from shareholder rights of the underlying stock, like a dividend. Exercising a put option can allow you to exit a position you may own. Now, this is rarely the best strategy, as it's almost always better to sell the stock in the open market or to sell the option. Lastly, let's discuss opening and closing option positions. The number of shares available to trade in a particular stock is called the float. If there is a need for more stock, shareholders will have a vote, and the company will go through a registration process before issuing new shares. Because options are offered based on demand, the potential number of contracts is limitless. When you enter an order to buy an option, there may or may not be a contract already in existence with a counterparty willing to take the other side of the trade. If not, your demand will create a contract until a counterparty appears. There are 4 transactions unique to options: buying to open, selling to close, selling to open, and buying to close. Throughout this video, we have discussed the first 2 when buying a call or put option. However, the last 2 are used to open and close a position for an option you do not own. As mentioned earlier, this is further discussed in Options Trading 102, but is really for more advanced traders. For now, let's do a live option buy and sell for those simple transactions we discussed earlier.
So today we're going to be purchasing an option on the Wind Energy ETF FAN. As a reminder, you can purchase options on both stocks and optionable ETFs. To get to the options contract, at least in WeBull, the options button is down to the bottom right. You just want to select that, and that opens up the view for multiple options with different strike prices and different expiration dates. And as I stated earlier, I like particularly long options, so I'm going to go with the 89-day option here that expires on the 18th of June, 2021. With options, you can also pick a strike price that has already been passed by the current stock price. With the current stock price at $21.42, I'm going to go with the $23 strike price option, as I'm pretty confident the FAN ETF will move above that price in the future. Similar to stocks, you want to review your option order and make sure it's the exact price and the metrics that align with your investment strategy. As with all call option buys, I have an unlimited max profit and a max loss of $100. That is because the limit price of this option is $1 per share, and each contract has a minimum of 100 shares. In WeBull, you can use the graph metric to determine how much money you will lose or gain depending on how far the stock price moves. And lastly, you just want to confirm your order, make sure everything's correct, and hit that confirmation button to submit. Now, because options can only be submitted during specific trading times, I will have to resubmit this at a later date. However, because I already own a call option on FAN, I can go ahead and still simulate a call option sell. This follows a similar process as buying a call option, where you want to set your limit price and ensure that all of your parameters are correct. The premium is the amount of money you can expect to make by selling your call option, or the amount of money you can expect to pay when buying one. And when you're ready to sell, just hit that confirmation button to submit your order.
Well, that brings us to the end of the video. Please like, comment what you would like to see next, and make sure you hit that subscription and notification bell so you'll be alerted to future videos like Options Trading 102. And as always, keep finessing.